Hello friends, welcome back to part 14 of James and Loki's latest Tesla earnings forecast video review series. Let me bring in my co-host Loki, who is excited about something. He's been barking outside. There's nobody out there. I just showed him there's nobody at the door, and he's upset about that. So let me give him something to chew on besides his dog bed. And we'll make this an episode of Breakfast with Loki. Yes, there you go, buddy. There's your breakfast if you want it. Alright, we'll see if he wants to eat his breakfast or if he would rather keep chewing on his dog bed. One of those two things is going to happen. And we have gone through all of the pretty charts in my forecast thread that I posted to X. So from here on out, I'm not even going to look at those tweets, those last 40 tweets from that 69 tweet thread. I'm done with that. Instead, what we're going to do is look at my live Excel forecast model, because that's what is pictured in those slides. Now, I'll just show you briefly the way that those slides, hold on, I'm on the wrong thing. Go to my bookmarks here, and I'll find this thread, and I'll scroll on down past all the charts that we've already talked about in the previous 12 parts of this video review series, to get to the part where we are now. So we looked at these charts, and then I said the tour of my detailed forecast model begins with the summary section on row 1167, and that is where I'm going to start, which is my forecast for total income statement in the format Tesla reports it, including with GAAP net income. First, I tell you what time it is. Later, I tell you how I built the clock. So that's how I do the thread. And let me move this camera so you can see Loki eat breakfast. Because he's gonna eat. Right, buddy? You're gonna eat your breakfast. Yes? Good boy. Alright, so we get to see Loki eat breakfast. For those of you who don't care about the income statement, you can watch Loki eat his breakfast in the Loki cam right here below me. But what I mean is, in the thread, I'm showing you 16 columns worth of data, 2022 through 2025, which is fine, but the print is way too small for you to be able to read this. You're like, I know, I'm looking at it right now. I can tell those numbers are way too small for me to be able to enjoy the video like this. So instead, I'll get rid of this Twitter window. I'll show you this. See how the numbers are a lot bigger and you can read them? Okay. So here's row 1167, where our tour begins, right after the cost of sales percent section. That'll be the last section that I show in part 16. This is part 14, and I'm going to get through a lot of material in this video. Beginning with this, automotive sales including credits. This is the revenue Tesla makes selling vehicles. So you can see I've got 2018, 2019. Look how much this has grown over the years. 2020, 2021. We went into double-digit billion dollars worth of revenue in Q3 of 2021. And we have since passed $20 billion per quarter worth of automotive sales in Q4. A little below that in Q1. A little above it in Q2, and I'm projecting right at $20 billion worth of automotive revenue, automotive sales revenue in Q3. So one of the items that's usually included in that number is regulatory credits. Tesla has started breaking that item out separately, so I have also broken that item out separately, since it looks like that's the way Tesla is going to stick with reporting this information. Loki, did you finish all your food? You did. All right. You have earned a reward. Yes? Good boy. You get dessert? You get dessert, buddy. Yes. Come on down and collect your prize. Yes. Good boy, buddy. Yes. Good boy. Dessert for Loki. Yes. Yes. Good boy, buddy. All right, so that's my automotive revenue forecast. And if I spend as much time on every row as I just spent on automotive revenue, this is going to be a 6-hour long video, so I have to move faster than that. Here's my forecast for regulatory credits. I just left myself a note over here. What does INCL.CTA mean over here? That means including currency translation adjustment. There's two different kinds of foreign currency impacts on Tesla's income statement. One of those is when Tesla actually exchanges one currency for another. That has a financial impact. And the other one is just that Tesla has to report in one currency, their home country's currency, all of the amounts of money that they have or transact in every country, whether those transactions happen in dollars or in a foreign currency like the yuan or the euro. Those are the two biggest ones that are apart from dollars. So all of those have to be translated back into US dollars to be reported, and that has a financial impact as well. So you got two of those currency impacts, and one of those is currency translation adjustment. So for the regulatory credits Tesla's making in China, those have to be translated from yuan back to US dollars, etc. So that's what I've got here. Then there's the leasing and resale revenue. This is talking about people who aren't buying a new Tesla with cash outright. When I say with cash, of course they can be financing that purchase too. I just mean they're going to be the owner of that vehicle when they're done making their payments, right? So leasing, by comparison, is delivering a new car to someone who's going to make payments for 36 months on a portion of that vehicle's original value and then give it back to Tesla. And then Tesla has to resell that used vehicle to somebody else, which is what the resale revenue portion here is about. So that gets you the total automotive division revenue for Tesla. I'm forecasting about the same number we saw in Q2. Q3 may not be very different, right, from Q2. Energy generation and storage is probably the biggest difference I have on the whole P&L. Services and other also, I'm forecasting more revenue for both of these. Now, these are not the most profitable divisions Tesla has, so the impact on gross margin isn't that great. So on total gross margin, we are improving from $4.5 to $5.1 billion. None of that is coming from automotive, or very little of that is coming from automotive, because you can see the automotive cost of sales I've got decreasing by about $0.6 billion. At the same time, I've got the revenue decreasing by, 150 million, 200 million, something like that. So there is some improvement from automotive on gross margin. Very little on energy generation and storage, right, because the costs are going up by almost as much as the revenue is going up by. And the same kind of deal for services and other. So that's how you get to your $0.6 billion worth of gross margin lift at a little better gross margin. I'm forecasting it at exactly 20%. Let me move this camera back over. And get you the best angle on Loki, which is a high angle shot down at him. So I got that set up for you for the remainder of this video. Alright, what else is on here? Research and development saw a really big number in Q2. Now maybe that should have indicated to me that the new normal is that research and development will be higher numbers from now on. But if you look back over the prior quarters, a lot of them were lower than this number considerably. Like, I don't think anybody that I follow forecast this research and development number to be that high. I've got it paring back some in Q3. Still a pretty high number. Still looks like the second highest ever, but a little less than we saw in Q2 when that really big, nearly $1 billion worth of spending happened in research and development. Now, could I be wrong? Could this come in at $1 billion or over $1 billion? It could. Tesla's doing a lot of Cybertruck pre-production right now. And those costs are going to hit research and development because Tesla isn't selling those cars. Those don't count as regular production, so they're not going to hit regular cost of goods sold. Those trucks aren't being sold. They're being used for internal testing and development and fine-tuning and measure and adjust and whatever else they're doing, crash testing, cold weather, hot weather testing, etc. So could this number come in a lot higher than I'm forecasting? It could. SG&A, I'm forecasting a record high. This one passed $1 billion in Q4 and has stayed above $1 billion since. So I think it's not that unreasonable to expect a little further growth in SG&A relative to what we saw in Q2. Then for restructuring and other, I'm not aware of any reason there ought to be a number that hits here. In the quarters when Tesla does layoffs, those hit here. I left myself a note that there was some Bitcoin impairment back in Q2 of 2022, along with the restructuring and other that hit. So most quarters this is 0, and I'm forecasting 0 for Q3 and Q4 of 2023. Then we have the income or loss from operations after the total operating expenses. You can see these are almost exactly the same number, just a little trading off between these two lines happening. So operating margin I've got at 11.7%. Who knows what we're going to get? That's where my forecast is. We dipped a little bit below 10% for the first time in many quarters in Q2 due to a lot of price cuts and stuff. But for reasons that you'll see in the following two videos, parts 15 and 16, the weighted average mix of Tesla's revenue and cost of sales is gonna be favorable, right? That's what I'm forecasting anyway, for the gross margin percentage to improve almost 2 points. So that's really what you're seeing here, is just that flowing through relative to what we saw in Q2. Then we have the interest income line. Interest rates are higher than they've been over the past many quarters, and Tesla has been adding to the amount of money they're depositing in interest-bearing investments like certificates of deposit and U.S. Treasuries. So probably we're going to see a higher number in Q3 than we saw in Q2. That's my forecast. Then for interest expense, this has been pretty steady the past few quarters. I've got that coming down some. We'll see. Maybe Tesla is borrowing against their revolving credit facility, and it'll be more expense than that, but it shouldn't be a big number. And then we've got other income / expense net. Now this is the one that drove some of the Tesla Q short sellers and trolls crazy, because in the prior several quarters there hadn't been a favorable impact here. But there was a favorable impact here for currency transaction impact that we hadn't seen in other quarters. So when you're trading dollars for foreign currency, or foreign currency for dollars, or foreign currencies for each other, there can be a financial impact that results from having done that. And that needs to get recorded on the income statement someplace, and other income / expense net is the line where you have to put that. So it just happened to be a really big favorable impact in Q2 of a little over $0.3 billion. So that helped in Q2. I'm not forecasting that to happen in Q3. I'm forecasting it to go the other direction by a little, and who knows what this number is going to be. It's truly a wild card. We'll see what happens, but that gets us to income or loss before income taxes of nearly $3.2 billion. So among some of the best income before income taxes. So EBIT is what you're looking at on this line, earnings before income taxes. Then on the provision or benefit for income taxes line, here's another one where I'm going out on a limb and saying I think Tesla is going to declare some of the favorability they have coming to them from prior year's losses in Q3 to the tune of about $360 million. this number would be $360 million higher if I weren't assuming some of that favorability. Let me show you what I mean. If I multiply this term by 0, I would normally be forecasting $398 million worth of expense here for income tax expense, but I'm reducing that 398 by 360 million, saying Tesla is going to take some more of that deferred tax asset that they have sitting on their balance sheet in Q3. I could be wrong. Maybe in Q4 they'll take more than I'm forecasting here, but I think Tesla is going to use all of this before the end of 2023, and that's what's in my forecast. Would I be shocked to see $400 million number here instead of $38 million? No, I wouldn't be shocked, and in that case, this number would be $360 million less than this. So maybe $2.8 billion worth of net income or loss before the net income or loss attributable to non-controlling and redeemable non-controlling interests and subsidiaries, less buyout of non-controlling interest. What a crazy mouthful of a line that is. It's the everything else bucket that Tesla has on their income statement. So sometimes it's positive and sometimes it's negative. It was negative $89 million last quarter. I'm forecasting next to nothing in Q3 and Q4, so $1 million positive and $1 million negative. That's pretty funny. Using my formula that's just saying, who the heck knows with this wild card what it's going to be. Just give me the average of what it's been over the prior 4 quarters, and you can see that over those 4 quarters it was a really small number. So that's what you see there. And that gets you to the GAAP net income line. So I'm forecasting $3,145 million worth of GAAP net income for Tesla in Q3. And I've got the share counts below that. So I've got the basic share count, which is the shares outstanding. And then I've got the diluted. And the difference between those two is stock-based awards, convertible senior notes, and warrants, in case you wanted to know. So this number is what's currently the damage, and this number is what could be the damage if Tesla issues all the stock they might issue for stock-based compensation, convertible notes, and warrants. All right, so you got the basic GAAP earnings per share of 99 cents and the diluted GAAP earnings per share of 90 cents if you go with the diluted share count instead of the basic share count. All right, let's keep moving rapidly from there. So deferred tax asset, we did see Tesla take 21 cents per share worth of deferred tax asset. I mentioned that a minute ago. Back in Q4, they weirdly took 1 penny worth in Q1, nothing in Q2, and then I'm forecasting the remainder to be split evenly between Q3 and Q4, so it's a total of 45 cents, 43 cents worth of deferred tax asset Tesla can declare, and I'm saying they're going to split it evenly between Q3 and Q4. But I could be wrong. I am often wrong, so we'll see what happens. All right, what's this next row doing? I have a Tesla stock price forecast. If you believe 30 times the next 12 months adjusted EBITDA non-GAAP is a fair price for Tesla stock. Well, what would Tesla have been trading at over the past year and a half if you believed 30 times the next 12 months adjusted EBITDA was a fair price? Well, it would have been 178, 186, 183, 188. And then we start to get into what I'm forecasting the earnings to be, or the adjusted EBITDA to be, when we get to, this time period. And I've got it ramping up to 215, 254, 311, and 370 as Tesla's adjusted EBITDA, I expect, will grow in future quarters relative to what it's been in the past. And what we see next to that is what the trailing 6-month average stock price was for each of these quarters. So it was much higher than that forecasted amount in 2022. for a few of these quarters. And then they swapped off at the beginning of this year when Tesla stock was trading at very low prices, an average of 197, an average of 187. It very briefly got down close to $100, but then it shot right back up again. Tesla Q expected that it would continue falling, you know, $60. I saw people forecasting $50, $49, $35. Jeremy Raper forecast $8.86 is where Tesla was going to bottom out, but it didn't get close. I don't think it ever crossed $100. It popped right back up again, and is more like $235 as of my most recent swag at it, at where it's going to end, Q3 of 2023, which hasn't happened yet. Then we've got the trailing 6-month market capitalization. So Tesla had been trailing at a market cap above $1 trillion, and that fell to $900 billion, $800 billion, $700 billion, $600 billion, before popping back up again where it is now, around $750 billion. I expect that to go up in the future. Then, what was the highest CEO plan market cap achieved? I've got a few rows here for Elon's 2018 CEO Performance Award expense forecasting section. So that's what these rows are about. Quarterly annualized adjusted EBITDA. You can see $14 billion was where it capped out in the plan, but Tesla has been outperforming that, $14 billion. Quarterly annualized revenue, the highest in the plan was $150 billion. Tesla's still not there yet, but they did manage to max out all of Elon's tranches because he was eligible to earn 12 out of a possible 16, split between revenue, adjusted EBITDA, and market capitalization. He got all of the market capitalization and all of the EBITDA. So those got him all of those maxed out, and then he got some of the revenue goals, and that was as much as he was able to earn. He can't earn 16 tranches, only 12. That's where the plan was capped. It's complicated, so go watch my other videos on Elon's stock compensation if you want a better explanation. This is going to be a long video no matter what. Okay, CEO bonus forecast, milestones achieved. You can see he got to 12. 12 is the most you can get. Milestones not probable are still at 4, so there were 16 possible. But you can only earn 12. And so Elon has vested 304 million shares that he's allowed to purchase at the price Tesla was trading when the plan began. So March 20th of 2018, whatever the stock price was back then, that's the price Elon is allowed to buy 304 million shares of Tesla stock. Whenever he gets around to it, he's got until March of 2028 to buy those shares before they expire. But they are vested. So you got no CEO stock compensation happening at all this year. But again, he's got those shares of stock he can buy at a discount and then turn around and sell if he wants to. There's a provision in there that because he owes taxes immediately, he's allowed to sell as much as he needs to pay his taxes, but that he doesn't have the right to sell any of his shares of stock for 5 years after he purchases them. And now I have HDMI problems with my screen, and that's going to be problematic if it continues. Okay, I think it stopped. I'm going to have to not touch that cable because my connection isn't good. Alright, let's keep going with the forecast review. So you got your total SG&A expense here, which is the combination of the CEO stock compensation, the other SG&A stock compensation, and the non-stock SG&A expense. You add those three things together and that gives you total SG&A expense. Then I have to break out from the 10Qs when those come out the amount of stock compensation by income statement line item. So some of the cost of revenues is stock compensation for factory workers, and some of the research and development expense is stock compensation for people who work in research and development at Tesla. And then sometimes there will be an amount here for stock compensation and restructuring and other if there are layoffs where people get stock compensation. And that makes your total stock compensation. Then there's an other, including dilutive convertible debt and buyout of non-controlling interest line that sometimes has an amount on it. It didn't have anything in Q2, and I'm not forecasting anything for Q3 or Q4. But that's how you get to the non-GAAP earnings number, and I've calculated it two different ways here, which is a good best practice when you're making spreadsheets. If it's possible to calculate a number two different independent ways, why not go ahead and calculate it both of the ways and put them side by side to make sure they give you the same number? That's what I did here. You've got a direct method and you've got an indirect method of calculating non-GAAP earnings. And they agree, which is a good thing. So as a percent of revenue, I'm forecasting 13.9% non-GAAP earnings for Tesla, which is less than we saw last year, but better than we saw in Q1 or Q2, yielding non-GAAP earnings per share diluted of $1.02. In the previous video, I showed you a chart that had that $1.02 on it. Here's where it is on the Detailed Model tab of my Excel spreadsheet. Next, we get to the next 12 months non-GAAP EPS. So I've got $6.60 worth of non-GAAP EPS coming over the following 12 months. You can see this number stalled out for a while. 384, 399, 397, 412. Those are all pretty much in the same range, but I have it taking off again as we move into the future. This is the start of our PEG ratio section here. So if you buy a growth company, you don't care so much about the PE ratio as you care about the PEG ratio. What's the PE relative to the earnings growth this company is expected to have? And do those things make sense? Are they about the same? Is the PE ratio congruent with the growth expectations for this company, right? So you can see the earnings growth rate was as low as 1% in Q4 of 2022, which is really a problem when you marry it up with the PE ratio having been 58 at the time. That makes for a very wacky PEG ratio of 51, and that really screws up these numbers down here. A 12-month price target if you believe that the PE ratio is right relative to the amount of earnings growth. So you get these extremely high stock price calculations down here if you went with the assumption that a 58 PE was fair value for a company that was growing earnings 1%. Probably not many people want to pay 58 times the earnings if the earnings are only going to be growing at 1%. So that's what yields these. I already got a question about this when I posted my forecast thread. Hey James, you got some extremely high stock price numbers down here. Well, yeah, they're making that inherent assumption as part of the calculation for PE ratio. And maybe in the interests of time, I should keep moving past this section and let you refer back to some of my other videos on PEG ratio and how that works. I already reviewed the Stevenson indicator chart in a previous video as well, but what you can see is Stevenson indicator just increases by $1.69 every 3 trading days since Tesla stock split 3-for-1 and messed up my funny meme number that I was increasing the Tesla stock by. But by the end of the year, Stevenson indicator will be at $563. I didn't say the stock price for Tesla will be at $563 because Stevenson indicator is not a price target and never has been. It's just a very funny phrenology analysis, technical analysis indicator that Mayor Tucker at Fresh Jiva on X told me I should trademark because we both thought it was a very funny thing to post a chart about. All right, so here's your GAAP net income and the reconciliation down to adjusted EBITDA. How do you walk from GAAP net income to adjusted EBITDA? Well, first, you need to add back the interest expense because you need earnings before interest, taxes, depreciation, and amortization, right? Then what else do you need to throw out? The taxes, that's the T. Then you need to throw out the depreciation, amortization, and impairment, that's the D and the A. What's the difference between depreciation and amortization? Depreciation is on physical assets. Amortization is on intangible assets, the gradual writing down of the value of those kinds of assets over time. And then you got the stock-based compensation expense. If you want to get to non-GAAP adjusted EBITDA, you also want to throw out the stock-based compensation expense. And that's how we get to our EBITDA number here. And our EBITDA margin, I've got that at roughly the same adjusted EBITDA margin that we saw in Q2. And the automotive gross margin percentage I have being better, over 20%. Even after throwing out the regulatory credits, it would still be an automotive gross margin excluding regulatory credits of about 20% versus Q2 of 18, Q1 of 19, and then last year they were higher because Tesla was charging a lot more for cars last year. Okay, here's a section that totals up the production and delivery numbers. So this number isn't very meaningful. It's the max weekly production capacity, but Tesla does not make that many vehicles because you can see here the production efficiency is a fraction of this number. So you take this number times this number times this number. That's how you get to the vehicle production. I've got about 450,000 vehicles being produced in Q3 with 436,000 deliveries. Would I be blown away if Tesla delivered more than they produced? No, and in fact I am forecasting that that will happen in Q4. But for many quarters now, as Tesla's been unwinding the wave, what we've seen is production greater than deliveries every quarter for many quarters as Tesla builds up the amount of ending finished goods inventory. So you can see that number was as low as 14,927 to begin 2022, and it's been climbing ever since as Tesla has made that decision to end the wave and to not worry about how much ending inventory there is, to worry instead about minimizing cost per delivery. Stop paying all the expedite fees that were needed to hurry up and get all of these cars to their buyers and delivered before the end of the quarter to keep the ending finished goods inventory balance low. That does negatively impact your working capital, so you don't show as profitable in any given quarter, but you are more profitable across all future quarters if you do it this way, because you're focusing on keeping the cost per delivery as low as possible, even though that means this ending inventory is going to go onto your balance sheet at cost instead of at market value. You're going to sell these cars, these 100,000 cars that you end the quarter with in inventory for more than it cost you to make them, but on your balance sheet you're only getting credit for how much it cost you to make them as an asset. Whereas if you had sold all of these cars, you would have gotten the revenue for them and then you'd have more profit, is what that means. Okay, what's this next section doing here? Well, it's breaking down the revenue before currency translation impact by type. So this is how I forecast revenue. I forecast it with a base configuration, which is where you're getting most of your revenue. And then there's all these optional extras. Do you want to pay extra for different paint colors? Do you want to pay extra for a performance package or for different wheels? I've got the Cyberquad on here. I don't know how many Cyberquads Tesla's going to sell in the near future. I haven't seen it. Well, we don't have the configuration page for Cybertruck yet, so maybe it'll be there. That's been here for a long time. Then interior, do you want to pay extra for a different color interior than the one that comes with the base configuration? Do you want to buy full self-driving? That option is there for buyers. So that's the breakdown of revenue by type. It's nearly all coming from the base configuration, with a minority of buyers opting for each of these options. Opting for options. Taking the option. So the take rate is low on these, which is why the revenue contribution isn't very high. Then you've got the offsetting adjustment you need to make between the cash buyer ASP and the total automotive revenue, right? So one of those adjustments is that the people who are leasing these cars aren't paying for the whole car. They're paying for like 60% of the car and then giving the whole car back to Tesla after 3 years and letting Tesla sell it as a used car to recoup the other 40% plus worth of value they can extract. Then we have the destination and delivery fees. Those are not part of the order configurator, but they are part of total automotive revenue per vehicle, so you have to add that back. Along with the regulatory credits, the buyer isn't paying for regulatory credits, but Tesla is making money selling regulatory credits, so that's part of total automotive revenue. And then there's other. There's FSD, revenue declared off deferral, so previously deferred revenue that is now being declared, hits here. Over-the-air software updates for acceleration boost, for FSD subscription, for data plans, everything else that's automotive revenue hits there to get you to your total automotive revenue. Then if you wanted to exclude full self-driving, leasing, resale value guarantees, and regulatory credits, it would knock the number down to this number. So just a little smaller number here, maybe, maybe $0.1 or $0.2 billion less if you throw those things out. Then I have the deliveries excluding those that are subject to lease accounting. So if you compare, here it is, the total deliveries of 436 to this 413, that means I'm forecasting 23,000 of the deliveries will be to people leasing them instead of buying them outright. Here's the total automotive cost of sales dollars, 16.5 relative to this 21 means you've got a lot of gross margin left over with which to make earnings after the operating expenses and other below-the-line costs. 20.9% is the gross margin that would be indicated by these revenues against these costs. And here's the gross margin if you exclude full self-driving, leasing, etc. This is 1281 minus 1279, 1281, 1279. It's not gross margin, it's revenue excluding regulatory credits. I need to just go ahead and fix that. It's the revenue. I don't know why it said gross margin over here. And it's the automotive revenue, not all revenue. Automotive revenue. Oh, it's not labeled at all. Sorry. All right, this number is the gross margin percentage. This number doesn't have a description of any kind. I just wasn't paying very close attention. Okay, cost of sales dollars by type. So we just looked at the revenue dollars. These are the cost dollars. I shouldn't spend a lot of time on this. Just know that the base configuration is going to cost Tesla a little less. The deliveries are going to be a little less. So we shouldn't see a number as high if Tesla reports lower deliveries for base configurations as the factories ramp up and improve their economies of scale and just do continuous cost improvement exercises to drive down the cost of making vehicles. All right, that's what's in my forecast anyhow. And that gets you to the total automotive cost, same idea. Then you can see the cost of sales percentages by type here. So these went up some in Q1 from where they were in Q4 because the prices came down by so much. And I don't have the base configuration cost of sales improving by that much, by only 2 points there. Still higher than what we saw all year last year at 82%, and then going a little higher in Q4 to 82.9 before improving some more next year. And you can see what I'm forecasting for every line item if I'll stop moving around. You'll be able to see it anyway. For paint, performance package, wheels, interior, full self-driving is going to have a very low cost, but there is some cost, right? And that gets you to the cash buyer, cost of sales. Then you have these adjustments. It doesn't really make sense to have an adjustment for the leased vehicles like you do for revenue as a percentage, so I've left those blank. And that gets you to these net automotive cost of sales percentages down here. Total revenue per delivery. Tesla didn't sell very many Model S and Model X vehicles, so that's going to help some when the mix percentage increases for those. Even though the revenue per Model S and X sold will be lower, the weighted average revenue per delivery gets driven higher the more Model S and X vehicles you sell, even if you're selling them at lower prices, right? Because they're more than the Model 3. Model 3 is actually going through that Highland refresh in Shanghai right now, so don't expect there to be more Model 3s sold in Q3 than there were in Q2. If the other 3 vehicles are being sold more, then the weighted average revenue per delivery ought to be higher in Q3, is how I figure it. Then you got the total cost of sales per delivery going up by a little in dollars per delivery terms. Revenue per fully diluted share, I've got rising from Q2 to Q3, and 12 trailing month revenue per diluted share is still increasing. So the revenue growth, we saw that revenue growth chart looking pretty good. Same idea here. If you look at it on a 12 trailing month basis, and if you look at it on a per diluted share basis, Tesla's revenue is growing pretty steadily, despite the price cuts. Then I have a row here for GAAP net income excluding regulatory credits. If you want to throw those out, here's what's in my forecast. Not as much as we saw a couple of the quarters last year, but better than we saw in Q1 and Q2. If my forecast is right, here's the forecast for total Tesla deliveries by site and model if you just want the bottom line number. In the next video, I'll be showing you the detailed build-up to where this comes from and how I forecast that. So we do have some more Model S and X vehicles being sold in Q3 with a little bit more growth in Q4. Model 3s I have fewer deliveries. Model Y I also have fewer deliveries from Fremont. So total Fremont deliveries coming down with about the same Shanghai Model 3s here, 76,000 both of these quarters. A little less Shanghai Model Y here, but Berlin Model Y holding steady around 45,000. And Texas Model Ys I've got coming down some here in Q3 in my forecast relative to what I had in the forecast in Q2. And Troy Teslike does a better job explaining what's going on there than I am. A little bit less productivity out of Austin. So that makes these total deliveries that are down some. And you got the breakdown here by type, so a little less Model 3 and a little less Model Y being delivered. Also, I have Cybertrucks and semis here, so I've got 80 Cybertrucks in Q3, 1,600 in Q4, and then thousands more in Q1 of next year when Tesla ramps up production out of Austin. We're all looking forward to Cybertruck getting to production output above the break-even point so that those can start contributing some gross margin to Tesla and maybe be a really meaningful contributor to earnings for Tesla before very long. All right, next we have the total automotive revenue per delivery by model before foreign currency exchange impacts and foreign currency translation impact. So here's what these total revenues per delivery look like. S is going to come down in Q3, and it's going to come down more in Q4 with lower prices. Same with X. The prices came down a lot in the middle of this quarter, so they'll be lower in Q4 with an entire full quarter at the new lower prices. Then Model 3 shouldn't be as bad as it was in Q2. You know, Model 3 prices are higher following the Highland refresh from Shanghai. And Model Y ought to be a little higher in Q3 than it was in Q2. Those prices have been coming up, not going down recently. Then I've got Cybertruck at $77,000 per vehicle worth of revenue. Who knows what the real price is? For semi, I've got it around $350,000 per semi. What Pepsi is paying Tesla for the ones that they are testing out as semi continues to go through validation of that product before selling to other customers besides Pepsi. All right, total automotive revenue per delivery by type. This is breaking down the average for all different models combined, but by option type. So you've got those numbers here. Mostly it's the base configuration, same as we saw with the total automotive revenue, right? So here's what I have in my forecast by option type per delivery on average. So similar numbers in Q3 to what we saw in Q2. Yeah, not a whole lot of difference here. I've got the other coming down some here. What's doing this? This is the inventory discounts for a bunch of Model 3 inventory that Tesla was discounting. So I've put that in here on an average per all deliveries that Tesla has. It's not that big an impact as it is on the price. You know, it's like a $3,000 discount or whatever for the vehicles to which that applies because they were inventory vehicles. Maybe they'd been out for some test drives, maybe they had some miles on the odometer, so they got a discount for not being brand new. Here's one for FSD sales plus other revenue / deferrals. This is adding up $13.93 and $13.98. So if you add up the full self-driving and the other, here's what those combined are. It's a little lower in Q3 given those inventory discounts. Here's the GAAP earnings per delivery. I've got that number higher in Q3 than we saw in Q1 and Q2, which is good news. Non-GAAP earnings per delivery, same kind of story. Adjusted EBITDA per delivery, a little higher as well. And EBIT per delivery, earnings before interest and taxes per delivery, increasing some. Again, not to the levels we saw last year in 2022, but a little bit higher. Let me drag this column over a little bit to keep from... There, that's better. It's going to keep me from adjusting the columns every time I click on Q4. All right, what do we have for 12 trailing month deliveries? Is this number increasing? Yes. Over the 12 trailing months ended Q4 of 2022, it was 1.3 million vehicles. That's what Tesla reported for the full year 2022. And then as we move through time, Tesla is beating the prior year deliveries number, so this number keeps increasing. So 1.4, 1.6, 1.7, 1.8 is what I expect by the end of Q4, 1,837,000 vehicles delivered. How about 12 trailing month revenue? Is it the same story? Yes, it is. So we saw that on our revenue chart that it was $81 billion at the end of last year. That number has been increasing, 86 billion, 94 billion, 98 billion. I think it'll be over $100 billion by the end of 2023, which is good. 12 trailing month adjusted EBITDA. How's this number doing? Not as well. This peaked at 19.2 billion. Then in Q1 it was a little lower with year-over-year declines in adjusted EBITDA in Q1. Then it recovered some in Q2. I've got it going a little bit lower than that, so kind of hanging out in this $19 to $20 billion range on a 12 trailing month basis for most of the past few quarters, and I'm projecting the next couple of quarters will still be in that range. 12 trailing month non-GAAP earnings per delivery, you can see what those look like here, a little bit lower in Q3 on a 12 trailing month basis. non-GAAP earnings per delivery as we lose some of these higher dollar amounts that we saw in 2022 and replace them with the non-GAAP earnings per delivery we're getting this year. So a little lower there. I'll go ahead and tease out into the future so you don't think it's going to decline forever, that we'll get recovery in 2024 back to the same kind of levels we saw in 2022, and that it ought to go higher in 2025 as Tesla is able to charge more for vehicles and as more people want to buy full self-driving primarily. Okay, in this next section we've got revenue by type after currency translation adjustment. So this is the same stuff we saw in the income statement section, really. Costs and expenses by type are also here. So I used this to make those charts that we saw in the previous video on earnings per share. And many videos ago in my forecast review series, we saw how Tesla makes and then spends its average dollar of revenue. So I do that on a 12 trailing month basis. First I do it on a individual quarter basis, and then I do those on a 12 trailing month basis to smooth out the seasonality. I've got a row here that gives me the investor letter date format. That's important for some reason why I put it here a long time ago. I've got a check section here for totaling up the GAAP operating expenses two different ways. So I've got them as reported, and then I walk through the calculation of how you would get to it a different way, and I compare those and make sure I get the same answer either way. That's what that section does. I've got the cost of sales percentages here by income statement line item. So for automotive sales, including regulatory credits, I've got what the cost of sales percentage is. Then for leasing and resale, it's a little deceptive here because you're only seeing the first part of the cost of sales when you are getting the vehicle back after 3 years. That makes the cost of sales percentage look a little better. But then when you resell that vehicle to somebody else, you may not get as good a deal as this. Energy generation and storage, cost of sales percentage used to be over 100%, which is bad. You don't want that. You would rather have cost of sales percentages be as low as you can get them. And they've been coming down. So I've got the same 82% in my forecast for Q3 as we actually saw reported in Q2, and then holding at around that level in Q4. Services and other is about a 90% cost of sales business so far this year. I've got it improving a little bit with scale. Hopefully Tesla gets a little better on the services and other division. Then I've got the cost of sales percentages here by site and by product. So for each of the models Tesla makes at each site, what's its total cost of sales percentage? Model S and Model X were doing better towards the end of last year than they're going to be doing in Q3 and Q4 at much lower prices. That's why you see these returning to a 90% cost of sales on those. Really, the prices came way down on those. Then for Model 3, I've got it at a pretty high cost of sales percentage in Q4 relative to what we saw in Q1 and Q2, where I have it forecast for Q3. Model Y should be doing better. This is Tesla's top-selling product, and it should have a pretty good profit margin. You can charge a lot for a luxury mid-size SUV, and Tesla is still able to, yielding Fremont these total percentages. How about in Shanghai? Well, their costs are lower, so their cost of sales percentages are better than what we see from Fremont in California, where labor costs are pretty high. So that's my total Shanghai cost of sales percentage here. How about in Berlin? Are they over 100%? Well, I think last year, towards the beginning of the year, they were, but they've been improving since, and should do more improving on the vehicles they produce. Same with the Texas Model Y. It would have been higher cost, but should be improving to do it at least as well as Fremont is doing by the end of this year. They shouldn't have to pay as much per factory worker in Austin as they have to pay in the Bay Area of California, where the labor market is very competitive. And again, those state labor laws are unfavorable for business. Then we got Cybertruck here. It's going to be super high cost in Q3 and Q4. Semi, I have not producing enough to make a profit or have any gross margin at all. Tesla probably has over a 100% cost of sales percentage on Semi still. So that gets you to these total automotive cost of sales percentages, and then after you throw regulatory credits out, you get to these automotive cost of sales percentages, excluding regulatory credits. Looking okay in total to end the year. Maybe not as good as we saw last year, but still okay. How about for the non-automotive divisions for Tesla? Well, solar panels. I don't think Tesla makes any money selling solar panels. Solar roof, they might make a little bit of money. Energy production is not a huge cash cow for Tesla, but energy storage division is doing a little better. So for power walls, those probably have a pretty good cost of sales percentage, I think. Power pack, Tesla hasn't been selling those for a while. When they were selling them, they didn't make a lot of money selling them. Probably, we don't get this detail from Tesla, so these are my best guess. Then we have Megapack here, which I think should be doing a lot better as time goes by. So into the future, I've got these costs improving. Nowhere close to what Mark Henry at Zero Sum Game 33 expected Megapack would be producing. He thought the cost of sales would be about 25% by now. That's obviously not true if you read Tesla's income statement. There's no way you can make that make sense relative to the numbers Tesla is reporting. And then there's a little bit of other yielding total Tesla energy cost of sales percentages like these. All right, then we get to the services and other cost of sales percentages. Those are shown here. I've got those improving some, and those yield total cost of sales percentages. So we'll see this again in the next, in part 16, right before I end the forecast review series. What's this next section? Well, I've got total gross margin percentage by site and product. These are exactly the same as the section above, except they're 1 minus the cost of sales percentage. So we've already kind of talked through these, but if you'd rather look at it in terms of gross margin percentage than as cost of sales percentage, I have both of those views here. As you can see again for Semi, these negative numbers indicate that the cost of sales was more than 100%. So when you subtract 1, you get to these, or when you take 1 and subtract those cost of sales percentages from them, you get a negative number. All right, so that gives us our total gross margin, and you can also see the gross margin here for the energy generation and storage products, and services and other, and in total. Okay, what's this next section? This gives us automotive cash sales as opposed to leased units sold, so you can see the breakdown here between those. I'm expecting roughly as many leased vehicles sold in Q3 as we saw in Q2, maybe a little more in Q4. Automotive revenue, excluding leases, and automotive lease revenue are here. This is a small portion of Tesla's business, but for some of my charts I wanted to throw it out. So to throw it out, you have to separate it out, which I did. Then we've got the ASPs here. Let me check my phone. So it stops buzzing. It was irritating me hearing my phone buzz behind me. So I had to stop it from making noise. Before proceeding with the forecast review, here we have cash sales, cost of sales per vehicle versus leased sales, cost of sales per vehicle. And then what the total is, if you combine the two, you get a weighted average of the two that's closer to the cash sales, cost of sales per vehicle, because so many more vehicles are being sold as cash than as lease. You got the cost of sales percentages here for both. Same idea, the weighted average is much closer. This number is going to be bigger than that number if you take the decimal out, but they both round to the same number. Then we get to regulatory credit sales here. Automotive sales excluding leasing and credits. Cost of sales excluding leasing. I got so much information in my forecast model here. Cost of sales per vehicle excluding leasing. Gross profit dollars per cash sale. And gross profit percentage on cash sales. So here's what I'm forecasting relative to what we saw Tesla report over the last couple of quarters. And non-GAAP EPS, excluding regulatory credits. So if you say regulatory credits aren't a thing, let's throw those out. Here's how much I have in my forecast for Q3, given all the caveats we talked about already. Stuff like the tax expense might be a lot more than what I'm forecasting if Tesla doesn't take more of its deferred tax asset in Q3. Always so many wild cards. It's very difficult to get close on your earnings forecast, and it requires a little bit of luck, no matter what, to get very close. I've been fortunate enough to get very close sometimes, but not all the time. Then we have components of operating expense. I just went through a couple of these charts in the previous video for research and development versus SG&A versus CEO stock compensation. None of that happening this year. And restructuring and other. We may get through an entire year in 2023 with no restructuring and other expense, which would be a first. I think every previous year there's been something on this row. No, in 2020 it was zero. In 2020 it was zero. So every few years Tesla will get away with a year that has no restructuring and other on it. And you can combine those into larger groupings and get total SG&A like that. I can't give you the quarter end actual share price for 2024 because it hasn't happened yet. Let me move back over to where we've been for most of this video and show you that we don't have a quarter ending stock price for Q3 yet because it hasn't happened yet. We'll have that at 4 p.m. Eastern on September 30th. But I can't put it in here yet. 12 trailing month total non-GAAP earnings of $13.8 billion here. And a couple of these depend on this calculation, so we don't know what the quarter end PE is yet. But once we do, I'll be able to update that chart through Q3 that we saw in the previous video. Total Tesla global employee count, we only get this number once per year, so I have to just hang on to it from Q4 through the next 3 quarters that follow. I'm forecasting that it'll be 164,000 employees by the end of 2023. We'll get the number when Tesla reports it, maybe in January of 2024. But I do have all these calculations set up. I only do them in the quarter Tesla reports the count, because I think that's the right way to do that, and to not assume no growth between these. I could also have done like a straight line growth needed to get from here to here, and then I could have had numbers in here, but why bother? I don't use these revenue per employee, gross margin per employee, OPEX per employee numbers all that often. And when I do, it's usually to compare them against other automakers like GM and Ford, who report their employee count as well, just to show how much better a trajectory Tesla is on than those companies are. I've got those charts in here. Oh, here, let me just show you one while we're here. So here's a GAAP profit or loss per employee. You can see Tesla in the gray here is making more and more profit per employee every year, whereas GM and Ford are, with some volatility, basically flat to falling over this time period. All right, that was easy. Next is components of operating expense here. So you've got those on a 12 trailing month basis, if you need them. I labeled a row here the Brad Munkin net profit growth percentage year over year chart, and all years growth percentage versus 2021 Q1. So this was really funny. Brad Munkin thought it would be fair game to say that Tesla's growth in 2021 Q1 versus 2020 Q1 was more than it's been since. Well, yeah, because 2020 Q1 was an extremely small number. So if you were to compare every quarter against that one quarter, I made a video about this, you can go check out, then you'd still be doing great. You'd still be having earnings that are a large multiple of 2020 Q1. Let's just go ahead and compare everything to that quarter instead of changing it as we go. All right, what else do I have in here? Well, I've got the per diluted share section, which is giving you the entire income statement except as per share, everything per share. So we saw some of these, the $6.04, 55 cents, 75 cents. You'll remember those as being the revenue stacked bar chart we saw in the previous video. And then the rest of these are the other numbers that we saw in that video. Although this has it in greater detail, I did combine together some of this weirdness where you've got some small numbers that can be negative or positive. I just grouped those together to say everything else so that it would fit on a stacked cost per diluted share chart without having lots of teeny tiny stacked bars. And that's what's happening here, so I group those together so you don't have separate rows for restructuring and other taxes, etc. And that's that section. I've got a CEO stock comp and other areas, stock compensation per diluted share section here as well, so you can see where your 12 cents worth of stock-based compensation comes from before you get to your $1.02 of non-GAAP earnings per share. I put a section in here for some interesting info we got from Zach on the Q3 2022 earnings call. Probably I shouldn't spend time talking about that right now, but he gave us all some clues on how Austin and Berlin were doing in terms of their cost ramp. So I did this breakout to make sure I was forecasting stuff that made sense given that information for Austin and Berlin. So here we have the EPS chart, a section that I put here, energy revenue per share, energy cost of sales per share, energy gross margin per share. So you can see energy gross margin getting better than just a couple of pennies as time goes by, and Tesla sells more megapacks. Alright, then we get to my foreign currency translation adjustment section. I had to bring in the numbers I was forecasting first for the automotive sales and leasing and energy generation and storage and services and other, and the cost of sales that I was forecasting unadjusted. Then what you want to do is apply whatever index you need to the yuan and to the euro to get to the amount Tesla reported as being the foreign currency translation adjustment piece of the currency adjustments. I know this is very thick accounting at this point, but then what you need to do is figure out what percentage of your vehicles were being purchased with yuan. So for Model S and Model X, it's going to be very low because when you import those from Fremont to China, they cost a ton, like way more than what a Chinese buyer would pay for a comparable luxury car produced domestically. So not very many Fremont Model S and X are being sold in China and purchased with yuan, right? But a bunch of Model 3 and Model Y production is being purchased in China with yuan. Then let's keep going. So that's the assumptions that I'm making. You have to make them for energy and services as well, and for regulatory credits. So that gets you to these adjustments for, okay, then you have to do the same thing for cost of sales that you just did for revenue. And then you have to do that whole thing again, except with euros instead of with yuan. Okay, how many of your Model S and X vehicles do you think were purchased with euros? Well, it's going to be more, right, than in China. So greater percentages here. And then for Model 3 and Model Y, probably fewer because you've got local Model Y production now from Giga Berlin. So those numbers are going to be lower, probably. And you got the leasing components here. That should be a pretty small number. Then you got energy generation and storage and services. And you do the same thing for the costs. The costs are here. And once you have all those assumptions, you can produce the impacts. So Tesla told us how much the impact on revenue was in total for these quarters. So we know that the total impact on revenue was 0.6, 1.5, 0.8, 0.7. For as many of these quarters as Tesla told us what the revenue impact from currency translation adjustment was. And they also tell you what it is for gross margin. So if you know that, then you know how much the cost of sales percentage needed to be for each of these quarters. Now, do you see any amounts in Q3 or Q4? No. Why? Because I've decided I'm so bad at forecasting this that I'm not even going to forecast any. I'm just going to not bother and hope for small numbers, basically, for currency translation adjustment. But I do have to include it for each quarter Tesla has been reporting currency translation adjustment so that my numbers tie out. When you see that my numbers match for all the previous quarters, it's not because I have overwritten them by typing in the numbers Tesla reported. Oh no. I go back in for every quarter and I change my raw build-up assumptions from as detailed a level as I have them to change them by enough that they kick out a calculation that equals the numbers Tesla reported. That's how I do it. So I have to get my regulatory credits to match. I have to get my leasing to match. I have to plug in however much currency translation impact Tesla reported. And that's how I get to these impacts on gross margin. So they're pretty small once you get to the gross margin line, but they do impact cost of sales and revenue by materially more than this. So I thought that was important enough to include them. Is there anything else in here? Yes, of course there is. I've got revenue sections in here with detail by model and site, and the non-automotive sections for revenue here, giving me total revenue, and then I do the same thing again for cost of sales instead of revenue. So here's what that looks like for those sections. And is that it? Yes, that's the end of the section that began at row 1169. So I've taken you through 1,000 rows worth of my calculations. I'll just scroll back up here quickly to get us back to where we started. Yeah, this is what I do. This is my forecast. It's an extremely detailed model. I'm not aware of anyone who has a more detailed model than I have. So that's the trip back to row 1167 where this video began. In the next two videos, I'll walk you through how I forecast production and deliveries in part 15, and then how I forecast revenue and cost of sales in part 16, and that'll be it. And you will be ready to hear what Tesla actually reports for Q3 2023 production and deliveries. Let's check back in with my co-host Loki, who is curled up and napping after having eaten his breakfast. You saw him eat breakfast earlier. And with that, I will outro and say, if you've enjoyed today's video, click the like button. Please let me know that you liked this video on whatever platform you're viewing it. That helps my engagement on YouTube or on X or on the other one, Patreon. And thank you to everyone who has found it in their hearts to support my efforts, if you can afford to pay $4.20 a month on Patreon, or I recommend paying me $3 per month on X, which is 69 cents per week. My content, I think, is well worth 69 cents per week. You also get access to my exclusive series, James and Loki's Gems of the Week. Those videos are frequently over 1 hour in length, where I go through all the posts on X that I liked over the previous week and talk about them to give you my color commentary on why I liked them. And Loki helps me with those videos. You can also see him eat breakfast more often if that's the content you're here for. Because some weeks, that's the only way you can see Loki eat breakfast, is on the James and Loki's Gems of the Week series. But if you haven't subscribed to me on YouTube, you can do that for free. If you're watching me on YouTube, I'll leave a link over here you can click to subscribe to me for free and ring the notification bell to be alerted whenever I post fresh content. Thank you to everyone who supports me however you do that, especially my executive producers who join my YouTube channel at the executive producer tier, earning them a shout out and a thank you at the end of every video. Thank you, Kathy Kitchler and Rebellionaire.com, and I'll see you in the next one.